This video is being developed to assist the students to revise the accounting standards on a quick basis. The first accounting standard that I shall be talking about is the IAS 2 inventory. When it comes to IAS 2 inventory, the core principles with respect to IAS 2 inventory is the definition of inventory, which says inventory is an item which is held for sale during the ordinary course of business. The first thing is inventory is an item which is held for sale during the ordinary course of business. The second thing with respect to the inventory is it is an item which is held for use in the business for the production of goods or for the rendering of services Furthermore, if we talk about the inventory, so usually the inventories are expected to be those items which are expected to be consumed within the normal course of business. So this is generally what inventory is considered to be. So when I talk about IS2 inventory, it covers up this thing that an inventory is an item which is either held for sale during the ordinary course of business or is held for use in the business for the production of goods or for the rendering of services, or it's consumed within the normal course of business. When we talk about the measurement of an inventory, so what happens is you will measure the inventory at the lower of your cost or the net realizable value. When we talk about the cost of an inventory, the cost of an inventory is the purchase price. And what happens is you would add up the import duty, you would add up non-refundable taxes, you would deduct the rebates, you would deduct the trade discount, you would add up the conversion cost, and you would also add up the other directly attributable costs. What exactly are those directly attributable costs? The directly attributable cost of the inventory would actually mean that you are talking about the transport cost, you are talking about the handling cost, etc., etc., etc. They're all going to be considered as the directly attributable cost. So the inventory has to be measured at the lower of cost or NRV. And when we talk about the net realizable value, which is the NRV, so what is it? It's an estimated selling price. It's the estimated selling price. Less, it's the estimated cost to bring into saleable condition. The estimated cost which is to be incurred in order to bring into the saleable condition. And the last thing is basically the estimated selling cost. So whichever is the lower amount, that is the amount at which the inventory is going to be recognized. If I move a bit further with respect to the inventory, so there is something which is called the concept of cost formula. The cost formula of the inventory is going to be, the way you are going to establish the cost would depend upon whether your inventory is specifically identifiable or not. Whether your inventory is specifically identifiable or not. So in case if your inventory is specifically identifiable, or there could be the situation where inventory is not specifically identifiable. Now let's just try to understand this thing. When your inventory is specifically identifiable, then what is actually going to happen is that the specifically identifiable inventory is going to be measured at the specific cost. Is going to be measured at the specific cost. But if your inventory is not specifically identifiable, then you've got a choice. Either you can use the average costing formula or you can use the first in first out formula for the measurement of the inventory. Remember that whatever formula that you are going to be using, whether that be the average costing formula or whether that be the first in first out formula, so you have to ensure that you consistently apply that formula to similar type of inventory. So that is something that you have to make sure, that is something that you have to ensure. So that's it about IS2 inventory. That's a quick revision of IS2 inventory. Let's discuss about the next accounting standard, which is in the series, which is IAS 8, which includes the accounting estimates, which is about the correction of errors, and which is also about the accounting policies. So if I am gonna talk about IAS 8, which is accounting estimate, correction of error, accounting policy. So let's just try to have an understand that what exactly do mean by an estimate. So the estimate is you make different type of estimates whenever you perform the accounting. The estimation is used with respect to the provision amount. The estimation is used with respect to the depreciation method. The estimation is used with respect to the various things which is called the residual value is also an estimate. The useful life is also an estimate. This is all going to be considered as your estimation. Remember what happens is there could be multiple scenarios where the change in estimate could arise. So whenever there is a change in estimate that is actually going to arise, so what is actually going to happen is the change in estimate should be dealt with prospectively. What should happen is you should deal it prospectively. Now what do you mean by prospectively dealing the change in estimate? That is in the period of change and in future accounting periods. So when we talk about the change in estimate, so you need to apply the changes in estimate prospectively. What exactly do you mean by the changes in estimate? The changes in estimate are going to be, you have to deal with it prospectively. You have to deal with it prospectively. How do we mean by prospective dealing? That is, you have to apply the change in estimate in the period of change and in the future accounting periods. That's what the change in estimate scenario is all about. Let's move a bit forward and discuss about the other aspect, which is actually about the accounting policy. So if I talk about the accounting policy, so the different type of accounting policies examples is use of the average costing or use of the first in first out method for the valuing of the inventory. Similarly, the second thing is the cost model and the revaluation model. This is also one of the methods of the accounting. This is also another accounting policy examples. Then you've got with respect to the accounting policy, the other examples that you have is when we talk about the accounting policy examples, you've got the cost model or you've got the fair value model, etc. etc. These are the different type of accounting policies that you can adopt. Now, when it comes to the change in accounting policy, so remember the change in accounting policy is only going to be allowed if change is required by an accounting standard. If the change is required by an accounting standard, and the second thing is that the change or what could be the scenario is that the change would result in better presentation. The change would result in better presentation. That could be the alternate scenario. Remember, whenever the change in the accounting estimate, the accounting policy is going to arise, it is going to be dealt with retrospectively. What do we mean by retrospectively? From the earliest date. That is, for example, if you applied, if you acquired an investment property 4 years ago, so if there is a change in the accounting policy, then what happens is last 4 years financial statement. Last 4 years financial statements have to be adjusted in order to reflect the new accounting policy. Generally speaking, what happens is it's not practically possible to go about doing the last 4, 5, 6, 7, 10 years. So generally speaking, what happens is the comparative financial statements start reflecting the change. Generally speaking, what happens is the comparative financial statements start reflecting the change. Let's move a bit forward and discuss further, which is actually about the errors. So if I am going to be talking about the errors, let's start discussing about the errors. There could be multiple errors that you can make while preparing the financial statement. What are those errors that we may make while preparing the financial statements? So the errors could be what? The errors could be maybe that instead of using the life of 4 years, you might have used the life of 5 years. The error could be that you calculated 20% depreciation of 100,000, but you wrongly calculated at 25,000. The error could be you had to report a transaction for 45,450 and you recorded it like this, that 44550, which could be a transposition error. There could be an error with respect to the omission of the transaction, etc., etc., etc. There could be multiple types of errors that would possibly arise. So let me repeat that there could be multiple types of errors that could possibly arise. Now remember that whenever you come across these errors, let me repeat that whenever you come across these errors, so it's important that you rectify these errors. So in case if let's say for example in the prior year there is an error that has been made. So what you need to do is that you need to correct that error retrospectively. Now only if the prior year error was material. Only if the prior year error was material. If the prior year error is immaterial, then you don't have to rectify it retrospectively. That is okay. So it is important that you should understand if the prior year error was material or immaterial. So basically, this is all about IAS 8, which is the accounting estimates, the correction of errors, and the changes in accounting policy, and we've actually covered it up. Let's move a bit forward and discuss about the next accounting standard, which is IAS 10. What is this IAS 10? The IAS 10 is events after reporting period. IAS 10 is events after reporting period. Now, the important thing with respect to IAS 10 is that what exactly is an event after reporting period. So the event after reporting period are those events that happen from the end of reporting period. From the end of reporting period till the date of authorization of issue. Till the date of authorization of issue of financial statement. So what happens is when we talk about the concept of event after reporting period, so what happens with respect to the event after reporting period is that event after reporting period is the events that take place between the end of the reporting period till the date of the authorization of issue of the financial statement. The end of the reporting period till the date of authorization of the issue of the financial statement. That's what the events after reporting period are. Now, it's not necessary that you could say that the reporting period would be the year end. No, it could even be the quarter end also. So those transactions that happen between the end of the reporting period and the date of authorization for issue are going to be considered as event after reporting period. When we talk about these event after reporting period, the event after reporting period are categorized into two categories, which is the adjusting event and which is non-adjusting event. So it could be an adjusting event, it could be a non-adjusting event. What is going to be the adjusting event? What is going to be a non-adjusting event? Let's try to have a discussion of this. When we talk about the adjusting event actually are those events whose adjustments are made in the current year financial statement. Adjustments are made in current year financial statement. And the non-adjusting events are those events which are not adjusted, But instead, what happens is they are actually disclosed. So the non-adjusting events are those events that are not adjusted, but they are rather disclosed. Now, what exactly are the adjusting events? What exactly are the non-adjusting events? So the adjusting events are those events that provide evidence of conditions that existed at year end. That provide evidence of the conditions that existed at the year end. And when we talk about the non-adjusting event, so what happens is non-adjusting events provide evidence of the condition. They provide evidence of conditions that arose after year end. So basically what happens is, as I have discussed, that you actually adjust them in financial statement. And what happens with respect to the non-adjusting event is you actually disclose them if they are material event. You actually disclose them if they are material event. What are the examples of the adjusting event? What are the examples of few of the non-adjusting event? So let's try to have a discussion about the examples of adjusting and the non-adjusting event. When we talk about the examples of the adjusting and the non-adjusting events are, the adjusting events could actually be the news of the customer liquidation that arises after year end. The adjusting event could actually be selling of inventory at amount lower than NRV calculated at year end. So for example, if the entity's year has ended, and ultimately what happens is if the if this inventory is being sold at the lower of this amount, then what happens is if the inventory is being sold at the lower than its NRV, then that's an adjusting event. What could be the non-adjusting event? That could be the change in value of an asset. Change in value of an asset. What could be the non-adjusting event? The another non-adjusting event could actually be one of them is the change in the value of an asset. The second one of them is going to be the fire which might break after the year end. The ultimately acquisition of a subsidiary. So there could be multiple things that could actually arise after the year end, and they are going to be considered as a non-adjusting event. Now there are a few things with respect to the IAS 10, which is basically there is a scenario which is about the going concern. And what is that scenario? That there could be a non-adjusting event that will have an impact upon the going concern status of an entity. Let me repeat, there could actually be a scenario where the non-adjusting event could have an impact upon the going concern status of an entity. So if there is a non-adjusting event that is going to ultimately have an impact upon the going concern status of the entity, then what needs to happen is that you need to put in the adjustment of that, and the adjustment to that is going to be that you would then prepare the financial statements on an alternate basis. Now, what do we mean by this alternate basis? This alternate basis actually means that a breakup value basis. What do we mean by breakup value basis? The breakup value basis is that the assets are valued at the price at which they are sold. The liabilities are settled, the liabilities are valued at the price at which they could be settled. So that is what is going to be considered as an alternative basis. So basically that marks the conclusion of IAS 10, which is events after reporting period. The next standard is IAS 12 income taxes. When we talk about IAS 12 income taxes, the few of the things with respect to IAS 12 are that whenever we look at our financial statement, the tax expense in the financial statement is made up of two things. What are those two things? One of them is called current tax, and the other one of them is termed as deferred tax. When we talk about the concept of current tax and when we talk about the concept of deferred tax, so what exactly do we mean by the current tax? The current tax is actually your taxable income multiplied by the applicable tax rate. Your taxable income multiplied by the applicable tax rate. And when we talk about the deferred tax is your future tax consequences. Deferred tax is your future tax consequences of current and prior period transaction. So if we have to calculate the taxation, so when it comes to the current tax, as I mentioned that the current tax is your taxable income. What is your taxable income? Your taxable income is your income calculated. Is your income calculated in accordance with tax rules. In accordance with tax rules, that is considered to be your taxable income. Multiply by the tax rate, whichever is the applicable tax rate. You could have different income, which could be the capital gain tax, which could be the corporation tax, and the tax rate could be different to each one of them. So all that you have to do is that relevant income multiplied by the relevant tax rate. Relevant income multiplied by the relevant tax rate, and resultingly what happens is you end up getting the amount of the current tax. What do you end up getting? You end up getting the amount of the current tax. So the first thing is your current tax. Now, when we talk about the deferred tax, so the deferred tax is established using the SOFP liability approach. The deferred tax is established using the SOFP liability approach. And when we talk about the balance sheet liability approach, there are two terminologies which you need to be understanding, which is one of them is termed as a temporary difference. There is one of the terminology which is called temporary difference, which is established as the difference between the carrying amount of an asset or a liability and less its tax base. Less its tax base. When we talk about the temporary differences could ultimately be taxable temporary differences. The temporary differences could be the deductible temporary differences. With respect to the tax base, so for the easy purposes, what you could do is that you could think of it as a tax carrying amount. So whenever we talk about the deferred tax is actually computed using the SOFP liability approach. And when it comes to the SOFP liability approach, one of the very important thing is the concept of temporary difference. So when we talk about the concept of temporary difference, the temporary difference could be taxable, the temporary difference could be deductible. When we talk about the taxable temporary differences, what happens with respect to the temporary differences taxable is they lead to your deferred tax liability. They lead to a deferred tax liability. And when we talk about the deductible temporary differences, the deductible temporary differences lead to a deferred tax asset. The deductible temporary differences lead to a deferred tax asset. So if you have to establish a deferred tax liability, the deferred tax liability is going to be your taxable temporary difference multiplied by the applicable tax rate. Multiplied by the applicable tax rate. And when it comes to the deferred tax asset, the deferred tax asset is your deductible temporary differences. What is it? It's your deductible temporary differences multiplied by the applicable tax rate. So you need to do is that you need to keep this thing in mind that if we have to calculate the deferred tax liability, it's going to be calculated as your taxable temporary difference multiplied by applicable tax rate. When it comes to deferred tax asset, is your taxable deductible temporary differences multiplied by applicable tax rate. There are a few things with respect to the deferred taxes, which is that, for example, in case if there is a situation that you've got an opening deferred tax liability, which is 1000, and you've got a closing deferred tax liability, which is, let's say, 1200. So there is going to be an increase of 200 in the deferred tax liability. How would you record it? You would say deferred tax expense debited by 200, and you would say deferred tax liability credited by 200. In case if there is this opening deferred tax liability to be 1200 and the closing deferred tax liability to be 900, that means there is a reduction in the deferred tax liability. How would you recognize the reduction? You would say the deferred tax liability debited by 300 and the deferred tax income, which is also known as the deferred tax credit, is going to be credited by 300. So you can have a deferred tax income, you can have a deferred tax expense, both of them could actually arise. So what happens is you need to keep these things in mind when it comes to accounting for the deferred taxation. This is the basic concept of IAS 12 income taxes.